RESPA requirements have been implemented so that they can help mitigate possible violations. All of those involved in real estate closing process has to follow these requirements, and it is designed to protect the consumer. Under RESPA, for example, real estate agents and other settlement service providers must adhere to all key requirements to ensure transparency and fairness. This includes the GFE. Lenders have to provide a full GFE of settlement costs within 3 business days of receiving the loan application, so the applicant has an idea of what the total cost of this provisioning service is going to be. HUD-1, the settlement statement. This document itemizes all the charges that are imposed on buyers and sellers and how it's related to the settlement, and it has to be provided to the borrower at least 1 day prior to closing. They cannot be held at gunpoint at the closing table, and this be the first time that they've ever seen the settlement statement and how all of the fees are distributed. Mortgage servicing disclosure. That statement also has to be provided and provided within 3 days of the loan application. This is going to let the borrowers know whether the lender intends to service the loan or transfer it and sell it to another lender in, say, a pool action. We see that a lot with brand new builders because even though they have some great actions where they're taking advantage of some of these higher interest rates we're seeing, they can offer a lower interest rate and then sell off the servicing of that loan to some other lender that buys them in a pool. Affiliation business arrangements. These are the AFBA disclosures. If a real estate professional refers a client to any business which they have a financial interest, they absolutely have to disclose this relationship to the client at the time of the referral. And this includes agent to agent. If I send you to an agent out of state, I have to build what's called a referral document that fully discloses that I am sending it to them and if I am receiving a fee for that action. Initial escrow. This is the statement that's provided at or within 45 days of closing. This is the one that outlines the estimated cost that the buyer is going to pay into escrow for the property taxes and the insurance for the first year of the loan. All of that can change, but they have to build the initial statement so that they have an expectation of what may be required of them moving forward with the escrow servicing. And then, of course, an annual escrow statement. Lenders absolutely have to provide borrowers with an annual statement that summarizes every single deposit that went in and every payment that was made from the escrow account over that 12-month period. And then, of course, servicing transfer. Anytime a loan servicing is transferred to a new lender or a new loan servicer, both the old and the new lenders have to provide notification to the borrower of that transfer and any relevant contact information that is needed on both sides. When a violation is suspected, they will launch an investigation to determine if there's been any real breach of the law. The process often involves reviewing the transaction documents, interviewing involved parties, and assessing compliance within the RESPA disclosure. So this allows the provisioning requirements to be upfront and forward. If the investigation uncovers any evidence of a violation by a real estate agent or a lender, the CFPB can take enforcement action, fines, restitution, or mandate of corrective measures to prevent future violations, which can remove licensure from agents and from mortgage lenders. In addition, the CFPB can leverage State Attorney General, making it more imperative for real estate professionals to understand why RESPA is so important. They may initiate legal proceedings against individuals or companies that violate the act. For real estate pros, the consequences of a RESPA violation are pretty severe. This will not only be reputational damage, but you will actually lose your license and significant financial penalties beyond just your commission split. It's important for you to realize not only the law behind all this, but give you some examples, some guiding stories to keep you from falling into some of these traps. Let's talk about kickbacks and referral fees first. Let's talk about Sarah. Sarah's a real estate agent. Long-standing arrangement with a local title company. Whenever she refers a client to this title company, they give her a gift card as a token of appreciation. Although this may seem very innocent and just an appreciation of her business, this is a direct violation of RESPA because there can be no value exchange between business referrals amongst settlement services providers. So a title company cannot have a relationship with a real estate agent in which gifts and thank yous are exchanged. Mark, for example, is a lender. Mark tells his clients that their mortgage approval is contingent upon them using a certain home inspector who happens to be one of his friends from college. By mandating the use of a service provider and forcing a client to use one specific servicer, Mark has violated the RESPA Act. RESPA ensures customers have the freedom to choose anyone in their settlement service provider list, regardless of recommendations made by agents. You can certainly recommend, and I always recommend you give them 2 to 3 choices for everything that you do. And they should also be told that Google's a great place for you to go out and also find your own representatives for this part or this portion of the service. Next example would be excessive escrows. If a loan officer, for example, requires her client to deposit a large sum into escrow, accounting for the property taxes and the insurances, the amount requested, if it far exceeds what's obviously publicly stated or necessary, this will be a violation of RESPA. The excessive demand breaches the guidelines that sets limits and amounts required for escrow accounts. So if you can walk in to that lender with proof of what the escrows should be, you've called in public record and found out what the estimated taxes for this year and next year should be, you have it in writing, here's what the insurances should be, you have a quote from a strong insuring professional, it's very simple for you to have any type of escrow challenged and changed to meet those findings. Another example will be improper disclosure practices. A mortgage broker for receiving multiple loan applications for potential home buyers is considered a problem. If the broker neglects to provide any of the clients with the GFE within the required 3-day period after receiving that application, the GFE being critical because it outlines the anticipated settlement costs and translates the understanding of what the total cost of these services are going to be 3 days after the initial application is approved. The lack of transparency violates the RESPA's mandatory disclosure requirement. What type of transactions are covered by RESPA? RESPA applies to any federally regulated mortgage loan. This includes most of the residential mortgage loans today used to purchase, refinance, or improve properties with 1 to 4 family units. This is not a commercial action. This act does encompass loans made by banks, savings and loans, credit unions, or any other lenders that are insured or regulated by any federal agency. We talked about the consequences a little bit for you today. Violating RESPA can lead to severe consequences, including hefty fines. The restitution and payments to affected customers are hefty as well, and corrective actions mandated by regulatory authorities are strong-armed, including licensure revocation. Real estate professionals in violation can face a whole lot more than just reputation damage. The potential civil lawsuits behind it that have been initiated by the state attorney general's offices or private parties are massive, and they have been across the U.S. over the years, making sure that the end consumer and us as real estate agents are protected. So how do the consumers actually ensure that they're protected under RESPA? Consumers protect themselves by being vigilant and informed about their rights, much about what today is. If you don't understand how to read through some of this documentation, you're not Googling these things, or you're not actually getting this information presented to you when you're in the loan process, it's important for you to be able to listen to classes and YouTube sessions like this so that you have a better understanding. Education is always going to be your key. The diligence of carefully reviewing all of your loan documentation, every single understanding of your GFE, your HUD-1 settlement statement, your ALTAs, being aware of any potential conflicts of interest that are disclosed by real estate agents or lenders. By having a good grip on RESPA and understanding that in real estate, You can feel like you're constantly trying to crack a code. Honestly, it's all just about keeping things fair and square for your clients. This is your huge pro as a real estate agent. The act of protecting your home buyers from sneaky fees, shady dealings, demanding transparency and honesty from every single person that you're involved with in the actions, this will keep you out of these type of proceedings. For real estate agents, by you understanding the real estate terms and by following the RESPA rules is not just about staying on the right side of the law. This is about building trust and making clients feel confident in their big decisions. Make sure to keep it fair, keep it transparent, because when your clients win, your GCI will win as well. A little bit shorter session than what we're used to doing here at Keystone today, but this is a big action. There's a lot for you to think about here. And with all of the media attention and the negativity around the real estate agencies that are happening right now, it's important for you to know that you as a consumer and you as a real estate agent, your rights and the services to you doing business together are protected. And they have been since the 1970s. This isn't new. Work with people that you trust. Work with people that you know and that have proven themselves to be good, clean service providers.